Welcome to FinBot Insights. The conventional wisdom that stocks always go up over the long term is a comforting idea. It is also a dangerously incomplete one. Today, we are exploring the market's lost decades. History provides a stark counterpoint to the idea of perpetual market ascent. For 13 years, from the dot-com bust in 2000 all the way to 2013, the S&P 500 effectively went nowhere. We are going to break down a powerful academic framework that explains these long periods of stagnation and what they truly mean for investors. Here's our roadmap. We will begin by looking at the market through a different lens. Then, we will dig into the historical data that reveals the market's hidden rhythm. After that, we'll introduce a metric for reading the market's phase, explore the forces that drive these decades, and finally, break down what it all means for you. To truly understand long-term market behavior, we have to look beyond the daily noise of bull and bear markets. There are much longer, more powerful cycles at play that define entire eras of investing. The crucial distinction here is one of time scale. A sharp bear market can simply be a temporary dip within a massive multi-year growth phase. On the flip side, a powerful bull run can easily mislead an investor who doesn't realize they're inside a larger, stagnant, lost decade. Understanding the long-term phase is the key to correctly interpreting any short-term noise. This concept reframes market history entirely. It's not a steady climb up a mountain. It is much more like a series of massive ocean waves. You have periods of powerful growth, followed by long periods of just going sideways. For an investor, getting caught in the wrong part of that wave can mean a full decade of zero returns. Now, let's turn to the evidence. When we look back at over a century of market data, it becomes very clear that these cycles of growth and stagnation are not random events. They are, in fact, a persistent, repeating pattern. The clarity of this pattern is what's so remarkable. As this historical data illustrates, the market has consistently switched between two very distinct regimes: high-return growth phases, like the one from 1980 to 2000, and these stagnant lost periods, like the one that followed right after. This chart really drives home the economic significance. The performance difference isn't small, it's definitive. One phase builds fortunes through the incredible power of compounding. The other produces, on average, absolutely nothing. The market is playing a completely different game in each phase. So identifying these phases in the past is one thing, but the critical question is, how can we spot them in real time? Well, the research behind this framework offers a specific quantitative metric designed to do just that. You can think of this metric as a kind of market seismograph. It isn't tracking the price level, but rather the character of the market's movements. It's built to detect the subtle but critical shift from a stable growth environment to the volatile, high-loss environment that signals the beginning of a lost decade. This metric provides two critical thresholds. When a series of sharp, recent losses pile up and weigh on the market, the metric begins to spike. A reading above 3.0 has historically been the tripwire, signaling that the market has fundamentally shifted and entered a lost period. On the other hand, after a long period of calm and stability, the metric will naturally decay as the memory of those prior losses fades away. Once it falls below the lower threshold of 50.500, it is historically signaled that the consolidation is over, and a new growth phase has likely begun. So what drives these massive, multi-decade cycles? This isn't just random market noise. The data points to two powerful, deep-seated forces: technological innovation and demographics. There is a distinct pattern here. It seems that breakthrough technologies tend to emerge during the economic uncertainty of lost periods. Then, the subsequent growth phase is driven by the widespread commercial adoption and maturation of that very technology. Demographics also play a critical role. When the number of people in their peak earning and investing years, that's ages 40 to 49, is rising faster than the number of new workers just starting out, more capital tends to flow into the market. This creates a powerful tailwind for stocks. When that ratio reverses, a headwind emerges. Recognizing the market's long-term phase is not merely an academic exercise. It has profound and actionable consequences for strategic asset allocation and for risk management. The core takeaway is this: your strategy must adapt to the market's long-term phase. Buying the dip during a recession is an excellent strategy in a growth period, but that same strategy can be a painful, protracted mistake in a lost period. Your portfolio should not be static. It must reflect the character of the decade you're in. This analysis provides a structured way to contemplate the market's future.
It encourages us to move beyond short-term forecasts and instead consider the inevitable rhythm of these long wave cycles, posing a critical question for all long-term investors.
And that concludes our breakdown of the market's long wave cycles. If you found this analysis valuable, please click like and subscribe for more data-driven content. And please remember, this explainer is for informational purposes only and does not constitute financial advice. Do not trust social media influencers, including this channel, for your investment decisions. Always conduct your own research.